Hey guys, Jared Wesley here of Live Traders, and it's that time of the week. It's lecture time. This week's lecture, as most of my lectures are, is twofold. We're going to start off this lecture, guys, by talking about how to get started as a day trader. That's probably the first 15 or 20 minutes. I don't spend too much time on it. I give you kind of the basic process that you need to go through if you want to learn how to trade, not just intraday trade, but swing trade, core trade, etc. I also show you guys some of my office space, which I'll do a short little video of a little bit later. And then after we get through the how to become a day trader section, I go into market cycles. And I think it's a very important topic that you guys really pay attention to this, because what we're going through now, guys, is an area in the market where most people, the average person, says, screw the market. I'm dumping all my portfolio. I'm dumping all my stocks. I'm never getting back into the market. And unfortunately, that's the time you should generally be getting into the market, is when everybody else is getting out of the market. So I want to talk about the different stages, the greed stages, the fear stages, the apathy stages, distribution stages. And I want to talk about the emotional thought process that goes through people's minds when we go through those stages. Because at the end of the day, we are not trading stocks. We are trading people. We are trading human emotions. And I hate to say it, the average person is always behind the trend. They love to curse wealthy people and rich people, but the truth is, it's the man in the mirror that's wrong. Back in 2008, 2009, the market dropped 30, 40%, and everybody was like, screw the markets. I'm never getting back into the market. Well, how'd that work out for you? The next 10 years, longest bullish run in history. So you guys are always doing the opposite of what you're supposed to be doing when you're supposed to be doing it. So this lecture is very important to keep you on the right side of the market. So we talk about this from a 1-minute chart perspective all the way up to a weekly, monthly, yearly chart perspective. I'm commenting on that because it's useful for intraday traders, it's useful for swing traders, and it's useful for long-term investors as well, to get a gauge of when is a good time to buy the dips and sell the rallies, etc., and so forth. But the average person is simply doing the opposite of what you're supposed to be doing, and that is not a good way to make money. In fact, it's a great way to lose money in the markets. I'm just getting a lot of comments from people I know, emails from people about dumping their portfolios. You're doing it at the wrong time, guys. Okay, so we start off with, hey, how to become a trader if you're new, and then we transition into market stages. It's a very, very useful lecture in my opinion. But before I get into that, guys, check out my office for a quick second. I'm putting this up on video because I'm getting a lot of questions. Hey, Jared, what does your setup look like? What does your office space look like? It's relatively simple, but you can see it here right now. Check it out. All right, guys, so this is my office space in Arizona, okay? You can see over here, this is my trading platform, okay? 3 monitors, pretty simple. It's kind of what it looks like if I'm sitting down at it. I'll pull it back a little bit. That's it. Pretty simple. Left monitor is my watch list. Middle monitor is my battle station, and my right monitor is for scanning as well. So you can see, there's the thumbnail watch list. There is the battle station where I place my order entry, and this is where I look and scan as well. Pretty simple, guys. Okay, up top, reading list. Okay, you can see I have mentorship manuals over there, some vacation books, professional trading strategies, trade your way to financial freedom. Notice I also have psycho-cybernetics, and that is the Scottsdale office, one of 3. I have one in Florida, and I have one also in Pennsylvania. Guys. Hey guys, just heading to my office here. There's a trade I want to go over with you guys in just a minute. There's the beautiful ocean view from the penthouse. And let me head back to my trading rig, my trading setup here. All right. I'm going to go over a trade I took today on ACAD. But let me first get situated. There's my desk, guys. You can see I got a couple cameras there as well. Mentorship manual, a little bit of water. Big time respect for this gentleman right there, okay? And this is where I trade from, okay? This is my rig, this is my setup. And don't forget, if you like this video, click that like button, smash, hammer, crash that subscribe button, guys. Look, we're different than everybody else out there, giving you real quality information for free on YouTube so you guys can stay out of trouble in the markets. Not some of this fluff stuff. I'm not pole dancing in my videos or doing anything else like that, but real hardcore information to keep you out of trouble and hopefully make you a better trader and a better investor. Jared Wesley, let's get to it. This week's topic is twofold. In fact, I think most of my lectures are kind of twofold. One is how to get started as a trader, and that's a kind of a short 15-minute topic I want to put out there because I think that I've been getting questions recently a lot about that because I think with what's going on out there in the world and Corona, et cetera, there's a lot of people that are interested in learning how to trade. So I want to talk about that briefly. It's not going to be that long. And then after that, I want to dig deep into the emotions of market cycles. We're going to talk about stages 1, 2, 3, 4. And I think it's an important lecture because right now, with everything that's going on, not just in the world, but in the markets, people are getting a little bit scared. It's very interesting because I was at the bank yesterday, and one of the guys at Wells Fargo was one of their financial advisors or whatever, and he was saying how a lot of his family and friends are getting out of the market, dumping all of their portfolios because they're so worried the market's going to go lower, and they need to get out while they still have some money left. And I just shook my head like, you have got to be kidding. And it's not surprising because it happened in 08 and 09. So I'm going to talk about that specifically a little bit later because most people are getting out when they should be getting in and getting in when they should be getting out. And we're going to talk about that, not just as a trader, but as a long-term investor, core trader, you name it. But it's very important to understand the emotions that go behind how the market works. So you want to stick around for that as well. So let's dig in. But I think I'm going to make this a weekly part of my lectures as long as I keep getting the emails. Every week is going to start with this. When will the insanity stop? Okay, that's going to be a little segment. It's like a 60-minute TV show, and they have that little segment in there at the end. You know, when will the insanity stop? Okay, so this week I have 2 new emails for you guys that I've gotten in the past week. Both of them are sad. One is more sadder, if there's such a word. Okay? The first one is the sadder of the 2. The second one is just flat stupidity. They're both pretty foolish, but nonetheless. So this week's When Will the Insanity Stop starts with a college student. And this college student actually said, you can use this, Jared, if you... Oh, actually, you know what? I apologize. I flipped them around. That's the second one. Let's just start with pure stupidity. I put them backwards. I apologize. So here's a person who started with $150,000, doesn't have much experience trading, and through massive, unbelievable, incredible amounts of risk-taking, grew their account to $1.2 million in a matter of 3 weeks. Okay? So $150,000 into $1.2 million in 3 weeks. And then 2 or 3 days after that 3 weeks, like toward the end of that 3 weeks, they took their $1.2 million and brought it all the way back down to $150,000. Okay? The only comment for this one is stupid is as stupid does, sir. This person clearly is a gambler and has no money management. See, you guys have to realize one thing. To get up to $1.2 million, you have to be the world's biggest risk taker. Okay? So getting back down to 150,000 is what they call reversion to the mean. You didn't know what you were doing in the first place, which means you didn't deserve to be up $1.2 million in the first place, so it's not surprising you took your account all the way back down to $150,000. Most of you are thinking about this in the absolute wrong way. Many of you right now, tell me I'm wrong here. Many of you are going, gosh, I would have stopped at $1 million or 1.2 million. Of course I would have stopped. That is the wrong thought process. See, what you're missing is to actually get up from 150,000 to 1.2 million, you have to have a gambler's mentality, all right? And to know when to hold them and know when to fold them, well, a professional gambler would know when to fold them, but a hacker like this wouldn't know when to fold them. That's the reason they got up $1.2 million in the first place. Right? They were up to 660,000. They were up to 1.2 million. They don't know when to quit. That's how they got up this much to begin with. Okay? So my point I'm simply making is this is what stupidity looks like. That's it, right? This is what stupidity looks like. Guys, give me one quick second. Hold on. All right, there we go. So let's move on because I don't want to take too much time on this. All right. Next, this is the sadder of the two. When will the insanity stop? This is a college student who says, feel free to use this message in your weekly lecture video. So they knew that they were going to be a topic of this discussion, okay? Let it be an example for new young traders who are wanting to drop out of college to make a living trading. My plan didn't go so well for me. Here's my experience. There is where the first problem starts. My plan. Your plan was basically to gamble, okay? But let's get serious for a second. I've been attending college from student loans since my freshman year, and I had a surplus of funds from the loan of $12,000. This is a college loan we're talking about. College loan, okay? Rather than returning the money that I didn't need, I used it to open up a trading account. Wow, I used it to open up a trading account, okay? So this person, had a friend who in their dorm was a trader, and this person, he, quote, showed me a few things like charts, moving averages, volume, VWAP, and how to find momentum stocks. You ready? And I was watching a few other guys on YouTube trading stocks. So, and this is the best part. So I figured it couldn't be that difficult, because a college buddy of mine showed me how it works. I watched a few gurus on YouTube. I just figured, well, it couldn't be that difficult. Wrong. Okay. So I started out making money and actually turned my $12,000 into $14,000. So this person was up $2,000, and that was in January before the virus was an issue. You're going to note here, there's a little bit of victim mentality here. The virus is being blamed for much of this, okay? I even dropped both of my morning classes so I could trade in the morning and catch the momentum. But not long after that, things started to go downhill. I've since lost over $10,000 in the stock market, and I'm down to only $2,000 left. The last time I traded, I lost $4,000 in one day. That is all you really need to know about this person. Brand new, 3 weeks of experience, a month of experience, whatever, and they lost $4,000 in one day. Interesting, guys. I just don't know what to do now. I want to cry. Well, this is one of those sad stories that you feel genuinely bad. And this is where people are listening to their Uber driver, their cab driver for tips on the stock market, on Apple when it was going up, then it was Amazon, then it was Tesla. And now this person has a friend in the dorm that's a trader, and YouTube. Guys, I'm going to say it once and I'm going to say it again, and then I'm going to move on. This business is not a joke. It's a serious business. You will spend 5-10 years saving up $10, $20, $30, $50, $100,000. And as these two emails show, give it all back in 3 weeks, a month or two. Years of saving pissed away in weeks. Weeks. And this was a loan on top of it. The only thing worse than this was if it was like a credit card at 18 or 20%. At least the college loans are probably like 6% or whatever they are. But this is a college student who just lost $10,000 of their college loan that now they have to pay back. Sad. Okay? So I'm just showing this to you guys to scare you, yes, because they're real stories from real people. Because, I just figured it couldn't be that difficult. So you guys want to know why I hammer you so hard on money management? Because of stories like this. All right. Let's move on, guys. So we're going to get into how to get started as a trader. But before I do, I've been getting a question recently, more than most. What are my favorite trading books? All right. I thought I'd put a list of probably my 5 favorite books. So you guys can just take a look at this. I'm not going to explain each one in detail why I like that book. Psycho-Cybernetics is number 1 on the list, and I put them somewhat in order, okay? Because this is a self-responsibility book. It's talking about not being a victim, not having a victim mentality in life, that you control the cards. When you look in the mirror, that person in the mirror is the one who determines what you do that day, that week, that month. Sure, not everybody starts at the same place. Some start further back, some start further ahead. I get that. But that doesn't mean you can't better your life. All right, so Psycho-Cybernetics, the reason it's number 1 on this list is trading is filled with victims. The market maker got me. The virus got me. My platform shut down. Everybody's a victim. Nope, it's you. You make those decisions, so accept responsibility for them, okay? But these are my 5 favorite trading books. The first one has nothing to do with trading, and the next 4 have everything to do with trading. All right. Secrets for Profiting in Bull and Bear Markets is basically what all of technical analysis is based upon in many ways. Stan Weinstein did a great job. I think it was in the 1980s this book was written. Psycho-Cybernetics was in the 60s. All right. Everything else, very good books as well. I'm not going to spend much time on them, but everybody asks me, what are your favorite books? What are your favorite books? Why? Because everybody's too cheap. You know, like this college student right back here, they're too cheap to pay for an education, so they have to go and spend $5 on a book and think that they're going to learn everything. It's like I said earlier. Hey, you need brain surgery. The doctor from Timbuktu is there, and then the doctor from Johns Hopkins is there. Who are you going to choose to do brain surgery on you? You choose. All right? That's up to you. I'm not going to tell you which one to choose. If your spidey senses don't know which one, then, well, you know, that's on you. That's that victim mentality again. All right, so how to get started as a day trader. And like I said, the second half of this lecture, guys, is going to be about market cycles. So stick around for that as well. I'm going to go over this very quickly, like 5 or 10 minutes quick. Okay. What you first need is a computer, desktop, or a laptop. If you want to day trade, guys, you need 2 to 3 monitors. If you want to swing trade, 1 to 2. All right. Could you get away intraday trading with 1 monitor? You probably could, right? You probably could. But I think 2 is better. 3 is ideal in my opinion. You don't need the latest, greatest. All right. You don't need some high-end computer that runs 27 monitors and has some Core i9 Z-Max, whatever processor that just came out and is $9,000 for the processor. You don't need any of that. Go to Fry's Electronics, go to Best Buy, go to Amazon, find any computer that supports 2 monitors. Any computer that supports 2 monitors that's built in the last 2 or 3 years, and you will be fine. Why? It's not that intensive. If you're editing videos on YouTube, that's different. But if you're just being a trader, that's all you need. Swing trading, really 1 monitor, maybe 2. 1 is really all you need. Okay. Laptop, same thing. Little bit more power you might need on a laptop, but not really. It's not that intense. Okay. Open a brokerage account. There's a lot of them out there. I use TradeStation. You can use Thinkorswim, Interactive Brokers, Fidelity, Lightspeed, E-Trade, whatever. Just don't use Robinhood and eToro and all those crap ones. It's like shopping at the dollar store for a platform. Don't go there, okay? But these platforms, and you might be in a different country and you might not have these available to you, but I know TradeStation and Interactive Brokers are available in most countries. Most, not all, okay? Scanners. Most platforms have a good scanner. I use Dollar Gainers, Dollar Losers, but you can use external software. Trade Ideas is fantastic. FinViz is fantastic. Some of them are free, some of them are paid for. FinViz is free, but you can also pay for like 20 or 30 bucks a month. Trade Ideas is a little bit more, but it's probably the best in the business. Trade Ideas is an unbelievable scanner. Okay, but that's it. Simple platform. Open up a brokerage account that's a professional account that's not some crap one. Okay, I already talked about 2 that are crap. Once you open the account, and this is key, I'll spend an extra minute on this, okay? There's a lot of different kinds of accounts. If you're in the United States and you want to trade U.S. markets, you need to get over the pattern day trading rule, which means, and this is an SEC FINRA mandated thing. It's bullshit, but it's their rules, and that you play in their playground, so you play by their rules, okay? You need $25,000 or more to take unlimited amounts of trades. If you have less than $25,000, you have some choices. You can open up a cash account that's not leveraged, and then you can take unlimited trades, but you can't short stocks in a cash account. You cannot short stocks in a cash account. If you have less than 25K, you can take 3 trades per 5 rolling day period. So let's say you have 10 grand in an account. They'll still leverage you 4 to 1 up to 40,000, but you can only take 3 trades on a 5-day rolling basis, okay? You can go with an offshore broker. Well, these are not regulated, but some people, yeah, everybody heard of Shore Trader? Wink, wink. You know, my point is, there's a possibility you'll lose your money. So if you do choose to go with an offshore broker, put as little money as you need in the account. Put just enough. Maybe you just need 5 grand or 7 grand. Put just that much in. Okay, why? Because there's no regulation. It's possible you could lose it. Most of them are reputable, but there's still no regulation. So your money's not FDIC insured, blah, 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 blah. Okay? You can trade CFDs if you're in Europe. These are illegal in the United States. These are illegal in the United States. All right? I think it's called what? Credit for difference or something? Contract. Contract for difference is what it is. You don't actually own the stock. There's a contract to difference.
something like that. You don't actually own the stock. All right. I don't get into all of it, but if you're in Europe, it's a viable way to trade. The spread is what you pay, and you pay extra for each trade because of that. But if you don't have 25 grand, it's something to consider. You can swing trade, right? As long as you don't buy and sell the same stock on the same day, you can buy and sell as many stocks as you want as long as you do it over the next day. If I buy a stock today and sell it tomorrow, buy a stock tomorrow and sell it the next day, you can do that unlimited. Okay. Or you can just start a GoFundMe account and see if you can get up to 25,000 bucks. I'm just halfway kidding, but some of you will try it. Okay. So those are your basic choices. All right. Your basic choices. If you have less than 25 grand, you can either take 3 trades a week. You can use a cash account, which has no leverage. When you're new, that's probably fine. If you have like 10 grand, you don't really need much more than $10,000 in buying power. You don't, because you're trading 5 shares, 10 shares, 20 shares. Okay. If you did a trade on Tesla, for example, Tesla's a $500 stock. You're probably going to have a $5 stop loss. Well, you need 2 shares of Tesla. That costs you $1,000, right? 2 shares of Tesla will cost you about $1,000. So if you had a $5,000 or $10,000 cash account, you could trade. And remember, in your first 6 months, your first year, you're only trading $10, $20 risk anyway. So a cash account would probably be okay. But you can't short stocks. That's the negative. All right. What to trade? Stocks, Forex, options, crypto. That's up to you. I prefer stocks because stocks have the most available choices. Thousands and thousands of choices every day to trade. If you want to trade Forex, it's cheaper to get into Forex. You can do it with a $500 account, a $100 account. The fact of the matter is, though, I'm sorry to say it, and I apologize to all you Forex traders out there, there's a bunch of hackers in Forex. And I'm not talking about computer hackers, a bunch of people that have $27 to their name, and they're like, I want to be a trader. You're not ready yet. I'm sorry. I'm just telling you. Oh, I have $412. I want to be a trader. You're not ready yet. It's not enough money to be a trader. Just because you pass a McDonald's and say you want to own a McDonald's doesn't mean you can buy a McDonald's. You got to save up some money for that McDonald's. Trading's the same way. Options are a great way to trade. You get better leverage in options. It's cheaper to buy the stock, okay? I'm not a big crypto fan. I don't know much about crypto, so some of you crypto lovers out there are going, Jared, don't dog on crypto, don't knock it unless you tried it. I'm just not a big fan of crypto. I like stocks because they provide me the most choices, the most opportunities, but it also costs the most amount of money to trade stocks. I don't have a problem with Forex. I think options are outstanding. These 3 I think are fine. No problem. Trade them. You want to trade futures, E-minis, whatever, that's fine too. Okay? Just personal preference. Time constraints, all that good stuff. Develop a strategy, guys, the time frame in which you're going to trade. Okay? Morning, afternoon, market open, last hour of the day, the stocks you're going to trade. New York stocks, NASDAQ stocks, Amex stocks, $5 to $500. You're going to trade, I don't know, $0 to $1,000. You have to make that decision. The style you trade. Are you going to be a day trader and get in and out of positions, 3, 4, 5 positions from 9:30 to 4? Are you going to be a swing trader where you hold your stocks for 3 to 5 days, 3 to 5 weeks? Or are you going to be a core trader where you're holding for months to even years at a time? Okay? So that's up to you. You have to figure out, what are your time constraints? What are your personality constraints, right? What are your financial constraints? Those things will help you determine, right, whether or not you're going to trade the morning, whether or not you're going to be a swing trader. And then, as always, it's in red for a reason. Money management and trade management rules. Without these, just don't even start. If you're going to come out like that college student and you're not going to get an education and you're not going to learn and you're just going to throw money at the market, you're better off going to Vegas because you'll have more fun. You're just going to be depressed. If you open up a $10,000 account like that college person did, $12,000, you think that your college roommate or somebody on your floor is going to teach you how to do this in 3 weeks, you're wrong. It takes 1 to 3 years to become a good trader. If you don't have 1 to 3 years, don't start. I'm commenting because there's a lot of people in this whole corona epidemic that want to be traders. I love it. I think it's fantastic if you're willing to put in the time and the hard work. All right. And then follow up. Okay. So those are the basic steps to become a trader. All right. Money management's number 1, so I put this slide in here so you guys don't blow up your accounts. Every single trade, every trade has a hard stop. That means you put it in the system, not in your brain, not mental stops, hard stops. You have an entry, you'll use a stop limit order for your entries. You will have a stop loss. You'll use a stop market order for your stop loss. And then you'll have a target. Your target uses a limit order. Entry price minus the stop price divided by your risk is how many shares you get. So if you wanted to risk $200, you would take your 20-cent stop. 20 minus 1980 is 20 cents. And you'll take 200, hit 200 on your calculator, hit the divide button, hit 0.20 because that's your stop loss. 200 divided by 0.20 equals 1,000 shares, right? This is backwards, whatever, okay? 200 divided by 0.20 equals your shares, okay? So they haven't need 1,000 shares in that scenario. Every trade has a hard stop in the system, has a limit order for a target and a stop limit order for your entry. Guys, if you don't heed this advice, go to Vegas. I don't care what your buddy told you. I don't care what Jim Cramer on TV told you. I don't care if you think you're special and different. You're not, because you're going to end up like this. Okay, if you don't use hard stops, if you don't use stop limiters for entry, you're going to get terrible fills. You're going to get filled, who knows, 50 cents, a dollar late, depending on the stock that you trade, and you're going to lose your money. All right, be smart. Don't be an idiot. Okay, next, this is what it looks like on the chart. This is what it looks like on the chart. You don't need a lot of RAM memory. Somebody's commenting, what kind of RAM do I need? 8 gig is fine, maybe 16 if you want to up it. Okay, it's up to you. Again, for just trading, you don't need a high-spec computer. You just don't. Okay, so here would be a 4-bar play. The entry is 106.75. The stop loss is 107.25. So you're going to get in at 106.75 using a stop limit order. You're going to probably give it about 15, 20 cents. So you're going to start your order at 106.75 and you're going to drag it down to about 106.60. That's the range in which you are willing to get filled. You're telling the market maker, please fill me in that 15-cent range. If you cannot fill me in that 15-cent range, don't fill me. If you use a market order, you could get filled a dollar late. Stupid. Don't do it. So you're going to get in at 106.75 using a stop limit order. You're going to use a stop market order at 107.25. Once you get in, set a bracket order. The bracket will set your target, set your stop, and then walk away. Walk away. Most of you guys are over managing your trades to begin with. Just walk away. All right. Let the stock, let the trade materialize. All right. So in this case, 106.75 minus 107.25 is 50 cents. That's a 50-cent stop. You want to risk $10. So $10 divided by 50 cents is 20 shares. That position would cost you $2,135. Okay. If you had a leveraged account, which most traders do, it costs you $533. That is how it is done. Stop limit for entry, stop market for stop loss, and limit orders for targets. Okay, are we clear? Good. Now, in terms of your setup, I'm going to go through this briefly. The main screen, the one that's kind of right in front of you, that should be your order entry, your level 2, and your time in sales. Maybe there's 2 or 3 charts. I have 4 charts on mine. Okay, I have 4 charts on mine. All right, you guys have seen it many times. Hold on. It looks like this. All right, give it a second. That's what mine looks like. I took Baidu today, made $451.70 on it. It didn't hit our target, but again, this is my order entry right here. If I want to buy a stock, I click in the blue. If I want to short a stock, I click in the red. I can choose my share size up here, okay? This is the charts that I'm looking at, or the stock symbols that I'm looking at. If I click on one, it changes the charts. I have a 5-minute, a 15-minute, a 2-minute, and a 1-minute. Why? Because pre-market, I've already looked at the daily and the 60s. So by the time they get onto this watch list, I've already done my homework and I already know which ones I want to trade. Okay? So that's the symbol list. This is order entry. If I want to place a bracket order, I can use order cancels order. I can use order sends order. It's a topic for a different discussion. This is Trade Station. So don't email me about it. It's Trade Station. All right? Blue is the entry side. Red is the short side. All right? Let's go back. All right, so layout, main screen, level 2, time and sales, and a few charts. Your side monitors, you might have 1 side monitor or 2 side monitors. You want to put your scanning charts and basically your watch list. That's it. Thumbnail watch list on one monitor and then your scanning charts on another. All right, so when I scan in the morning, all right, let me show you that real quick again. All right, let me show you real briefly. When I scan, guys, it looks like this. I'm using dollar gainers and dollar losers. All right, I'm looking, usually I'll type 60-minute into here. I'll take this off and I'm scanning the 60-minute chart in the pre-market and the daily. That's it. Before the market opens, I'm scanning the 60-minute and I'm scanning the daily. That is it. After the market opens, I'll switch this to a 5-minute, just like that. And I'll be looking at these on a 5-minute, 15-minute, 60, and daily. I'm looking on those 4 time frames. When I see a stock I really, really, really like, I move it over and I put it on this list, right? It just gets added to this list right here, okay? And now it's on my symbol list, and that's how I trade it, okay? Simple. Now, so order entry, guys, is the main screen. Left and right for scanning, for thumbnails, okay? Yes, there's a little bit of a lag, Mark. Left and right is for scanning and for thumbnails, okay? That's it. Now, what does all of this look like? It looks like this. That is my trading office in Arizona, okay? And I apologize, there's a little lag for some of you. Okay, that's what it looks like, all right? Over here, I have my 3 monitors, okay? I have my trading desk. These are all those books I'm talking about, all right up in that area, okay? Psycho-cybernetics, trading in the zone, blah, 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 blah. Printers over here. It's relatively simple, okay? That's it, all right? And there's usually a professional trading strategies book sitting right there, but I took it, okay? That's it. You don't need a crazy, crazy, ridiculous office. All right, that's good enough. I have an office in Florida because I have a place in Florida as well. Note, in Florida, I just use 2 laptops. Okay, that's all I do. All right, sometimes I'll bring an external monitor with me, but that's it. This is my office in Florida. All right, a little bit more upscale. All right, but nonetheless, this one has a TV in it, a sitting area, blah, 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 blah. Okay, so that's very, very simple though. And sometimes, like I said, I'll use an external monitor. That's it. Okay. Now, this is my office in Pennsylvania. I have a home in Pennsylvania. Okay, those are my 3 places I go. 3 monitors and a laptop, a little bit more. Why? Because I spend more time here. I usually only spend about a month a year in Florida. I spend 3 months in Pennsylvania. So I have a little bit more of a bigger setup here, if you will. Okay, and to be honest, I don't really use the laptop much here. I just use the 3 monitors here. Okay, I put these on the side because this is trading while you're traveling. All right, this is trading while you're traveling. If I'm traveling at a hotel and I need to trade, I have to trade, guess what? I'm going to use the hotel TV. Do I bring my 16-inch Asus? Yes, I do. I'll show it in a second. But I'll just use the hotel TV and a laptop, just like the top left picture here. This is Japan down at the bottom, okay? Little monitor here and my laptop, all right? Give it 1 second. There we go. California again. Monitor or TV from the room, my laptop. Japan, again, okay? Laptop, TV in the hotel room. Here, laptop, TV in the hotel room, okay? You see a theme here, guys? Hotel, 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 all right? Bahamas, California, Tokyo, Japan. Laptop, monitor in the hotel room. Over here, I'm down the shore, the Jersey Shore. I have my 16-inch Asus. Why? Because the TV in the bedroom wasn't close enough. So I have my 16-inch Asus that I bring with me, and then I use that. That's kind of what Unwall trades off of every day. For those of you who know Unwall, he trades off a laptop and a 16-inch Asus. Okay, that's it. All right, that's simple. Okay? You can do this from anywhere in the world you want. Anywhere in the world you want with a laptop. I'm not trying to pitch, oh, this is so great, you're going to get rich quick. I'm not pitching that. It's going to take a long time for you to get good at this. But you can do it from anywhere in the world with a laptop and an internet connection. Okay? That's it. All right. This, real quick, before I move on, this is what trading is not. This is what many of you are doing right now. You're like, all right, I have $1,300 to my name. If I buy the cheapest stock I can find, like this 50-cent WTRH, and if it goes like $12, I can get rich quick. This is not trading. This is gambling. I'm not saying you can't intraday trade these stocks, but don't come in with pennies to your name thinking you're going to buy some penny stock biotech garbage and it's going to rip up $8 and you're going to get rich quick. This is not how it works. It's not how it works, okay? It's a systematic approach to making money, and you can't do it with $400 or $1,000. Yeah, some people on Google are going to tell you that, and they're furus taking your money. Take my course. You can win with $300. You can't scratch 2 nickels together, and you're telling them that you can make $100 grand this year. You can't, okay? So this is not trading, all right? Now, I want to move on to market cycles. I spent longer on that than I really wanted to be honest with you guys. But now I want to talk about market cycles. Guys, when we talk about charts, okay, everything we talk about is in the context of the bigger picture. One candle, one section of a chart is not important. We want the whole picture. And this is one of the reasons that we use multiple time frames, right? Multiple time frames allow us to see the whole forest through the trees. Too many of you people are looking at a branch or a leaf on a single tree. You're not looking at the whole tree, the whole forest. You could be surrounded by a forest fire and you wouldn't know it because you're so focused on a branch or a leaf. Look at the whole picture. So candlesticks are only meaningful in the context of the entire chart. Okay? This bottoming tail in and of itself doesn't mean much. But in the context of the chart, it means a lot. Why? Because now it's down 1, 2, 3, 4, 5 bars with a bottoming tail. That is meaningful. There's context here. These are wide range bars. It's extended. Then you get a bottoming tail. The bottoming tail suggests buyers, buying pressure. That's meaningful. So when we retest that area, it becomes meaningful. So when you guys are looking to make trades, you really need to do so in the overall context of the chart on multiple time frames. Don't just focus on one candlestick. So let's talk about this, guys. Okay? The basic market cycle. I've talked about this maybe 4 or 5 months ago in a video. All right? And I'm going to show you a couple more slides after this with the basic market cycle. I want to explain this to you guys. Okay? You guys are not understanding why markets work the way they do. Markets work the way they do because of human beings. They've worked this way for 120 years. I don't care if you chart pet rock sales, Cabbage Patch doll sales, the sales of pot. I don't care what you chart. They have curves, bell curves, stages. They all do. Fashion trends, you name it. Okay? That's what we are trading. So the number one thing you have to understand is we are actually not trading stocks. We are trading people and the coinciding emotion that goes with it. Okay? Fear, greed, the need to be right, okay? Not caring, anxiety, supply, distribution, apathy, accumulation, whatever you want to call it. This is what we trade in the market. Everyone focuses on fear and greed. The problem is the average person doesn't know their you-know-what from a hole in the wall. So they need so much confirmation, but by the time they actually get into a stock or a trade, you're way up here on the trend. Okay, you're way up here on the trend. All right, so I want to skip this chart for a second. All right, these are the 4 stages. All right, accumulation, greed, distribution, and fear. Those are the 4 stages. But I want to go to this chart. I saw this recently. I hadn't seen it before, but I saw it recently, and I found it interesting. Okay, it's main stages in a bubble. All right, I'll give Dr. Jean-Paul Rodriguez, Department of Economics and Geography, oddly enough, Economics and at Hofstra, came up with this. Now, I have my own version of this on the next slide, okay? But basically, stealth phase, smart money, right? Awareness phase, institutional investors. Then there's the mania phase, and this is the general public, where you see greed, you see delusion, the new paradigm, denial, return to normal, right? Fear, capitulation. Capitulation, for those who don't know what this means you're giving up. You finally raised your hand and said, I've reconciled the fact, I've consigned myself to the fact that I'm going to take a loss on this and I'm okay with it. You're not really okay with it, but you're okay enough to get rid of it. It's basically saying the pain has gotten great enough that you're going to get out. Some people don't, a lot of people do, and then it's despair, okay? And then return to the mean, right? I found this to be a little bit interesting because I think it's generally accurate, but I think we need to put a little levity to it, and then I'll come back to seriousness. So I've rearranged this a little bit, all right, so what it should look like, because it should really look like this, okay? The stealth phase is Congress and everybody else having a good old time at our expense, okay? That's basically what this is, all right? You know, those few governors and senators a month ago who, you know what they did, all right? All right, so that's basically what the true insiders are doing, okay? And then you get, Gordon Gekko and you get the Goodfellas. That's the institutional investors. These are the people that really set the prices for most of this stuff. So you could really make the argument that these guys are one and the same. These guys. All right? So Congress, institutional investors, they're getting the inside track on things. It's a joke, but it's not really a joke. They definitely, absolutely get the inside track on things. Okay? And then what happens is the stock starts to move up. The general public starts to get a sniff of this. And then it starts to rip and get really climactic here. Okay? Really climactic. You know what? I don't know why those 3 dots are up there. Let's remove those. Boom, boom. All right, that's better. Okay? This is, Dumb and Dumber. So you're saying there's a chance. Okay? You're getting in up here, right here at this yellow dot. And you're saying, I knew I should have bought more. I knew I should have bought more. Right? And then as the stock moves up, you're going, yep, I'm the man. Right? I rule. Okay? This is how this happens. And then as it pulls back right to here, you're thinking, I should probably add some more. I knew I should have bought more over here. So maybe I should just add more right here. I'm going to get a better price. Okay? Pulls all the way back and bounces. And you're going, see, my ad was right. I did the right thing. I knew I should have added right there. It was the right idea. And then as it starts to go lower, indecision begins to creep in. Fear is slowly coming into your brain. Should I add? Because I'm not sure, because this doesn't feel so good anymore. I thought I was right up here, but now I don't know if this is a good opportunity or being foolish. I'm just not sure anymore. So this is where the indecision starts to creep, right? This is where the fear begins. And then as it tanks some more, shit, there's no early retirement for me. I added over here, so I'm all in now. I'm all in, baby. All right, on this one-trick biotech stock, I'm all in, and she's coming back down. And then you finally make the decision somewhere between no early retirement and F Wall Street, somewhere between this, to just get out. Get out. I'm done with those crooks on Wall Street. Everything in the world is their fault. Screw them. Right? I knew this was a bad idea. Right after over here, you're saying, I knew this was a good idea. I knew I shouldn't listen to that cab driver with that stock advice. And then I'm getting out. Now, why am I doing all this? Making some levity out of it. Why? Because these are the same things I heard in 2008 and 2009. Screw Wall Street. I'm never investing in the market ever again. Well, if you sold in '08, how'd that go for you? How'd that work for you? If you bought in 2009 in March or April, how'd that go for you? Market had the longest 10-year run in history. Okay? So the average person is behind the trend all the time. Why? Because the average person needs confirmation. They don't trust anything in the beginning. It's like your friend saying, you do it first, and if it works for you, I'll do it. Right? You stick your hand in the cookie jar first, and if it works out, then I'll follow you. Okay? Unfortunately, the average person does this all of the time. And the sad part about it is they let their prior experience dictate their future actions. So for example, this was a few weeks ago. I put up a chart. I should have brought it in today. I put up a chart, guys, and the chart said 62% of people were invested in the market in 2008. 54% of people in the United States were invested in the market in 2019. An 8 percentage point drop in the market over the longest 10-year bullish run we've ever seen. An 8 percentage point drop of people in the market. Goes to show people are stupid. They just don't get it. They're always behind the trend. You buy on pullbacks and you sell on pops. If this is a long-term investment, you just buy on the pullback, buy on the pullback, buy on the pullback. Okay? Now, I want to go back over this real briefly, and then I want to move on to a couple charts. Guys, the reason this works is this. When something first comes out, let's use fashion for an example. I've used this analogy in the past. When something comes out in fashion, the only person who really knows about it is what? The fashion designer. They created it. Nobody else knows yet. So they're in-house, they're making this new pair of jeans or new shirt or whatever it is, and nobody knows about it yet. So what's the first thing they do? To get this new product, they have a fashion show. And that fashion show is what? All of the in crowd, actors, actresses, other fashion designers, right? And then after that, it's still not available to the general public. What do? They give a taste to their friends, which are actors and actresses. So you get this new pair of jeans, this new blouse, whatever it is, and now Brad Pitt has it. Doesn't make sense, blouse, Brad Pitt having it. No, didn't mean it that way, but you get the point, okay? So Jennifer Aniston gets it, Brad Pitt gets it, all the people in the know get it. So that's here, guys. That's right down here at the bottom, right there, okay? And then after that, it's the other B-list actors and actresses, not the A-listers. So in finance terms, this is Goldman Sachs getting it, JP Morgan, Citigroup. Then after those guys get it, the hedge funds start to pile in. That's the B-list actors. Still famous, but not quite famous enough. Then after that, the wealthy get to it because they're the only ones who can afford it in here. Okay? So then that's the actors and actresses' friends. You know, all the people they know, the insiders of the insiders, so to speak. After the wealthy people get it, then about 60% of the way up, then you start to see it to the general public. Okay? Then the institutional investors are like, right, let's give a taste, right? Let's give a taste to all the people out there. Why? We want to boost our position. So when Goldman gets in down here, then the B-list actors get in here, stock's still moving up. And then by the time it gets halfway to 60% up, like, well, let's give it to Walmart. Let's give it to Target. Let's give it to those places. We need that last push. And then by the time it gets to where? The discount stores like the True, like Beals and stuff, that's up here. Guess what the institutional investors are doing? They're selling into you up top here. They're selling into you up top here. Why did you wait so long to get in? Because you didn't trust it down here. You thought, oh, I remember 2008, 2009. I'm not letting that happen again to me. There's no way I'm going to let that happen to me again. No freaking way. So you wait and you wait and you wait and you start going, maybe there's something more to this. Maybe I should think about getting in sooner. Or maybe I should start thinking about getting in. No, I'm not there yet. You know what? This happened to me once in the past. I got in, and I thought it was the right time, and the stock tanked as soon as I'm going to wait. So they wait some more, and they wait some more. And they finally get in up here. Shortly after they get in, the stock moves higher. They're happy. And then it fights sideways, like, oh, yeah, whatever. It's a long-term investment. It just needs a break. No, you are selling. You are buying into all the institutional sellers here. Okay, you are buying into all of the institutional sellers here. And then it starts to go lower. And you start thinking, well, maybe I should add some here. Still a good investment. I still believe in the company. And then as it tanks, guess what? Everybody runs for the door. Every fire sale. But to use a restaurant analogy, you can't all get out of the same door. 100 people in a restaurant, right? 100 people are in a restaurant. Some are sitting close to the door. Some are sitting in the back. The people in the back are getting burnt, literally. You're getting out down here. And guys, this cycle goes over and over and over and over and over again, okay? This is how the general public, this is why Wall Street is able to take advantage of so many people, because you don't understand the thought process, the emotion behind it. They upgrade stocks that are up 300%. Why? So it gets up 350% and they can sell it into you because now you think it's a strong buy because Goldman says it is. Bullshit. It's not. Okay? So I want you to think about this, because if you do what everybody else does, you'll get what everybody else gets. Guys, the 1% in this country makes $500,000 a year or more. The 1%. That means everybody else makes less. What do you want to make? Less or more? Well, if you want to make more, start doing what the 1%ers do and stop doing what the 99% does. Because the 99%, not all of them, probably 80 to 90% of the 99% are just sheeple. They just follow what they're told to do. Oh, he said it was a good idea, so I did it. I'm a college student. I took $10,000 because my roommate said it was a good idea. Do you guys remember that story? It wasn't that long ago. That's what sheeple do, okay? They're sheep. All right. So this is what it looks like on a chart. Not a lot of interest, not a lot of, look at the volume at the bottom. Not a lot of interest, not a lot of interest. Look at the volume, not a lot of interest. Look at the price movement, not a lot of interest. Okay? Starts to move up. This is the big boys getting in. Okay? They're accumulating their position down here. This is on a 1 minute chart, by the way. I'm showing it to you on a 1 minute because this can happen on a yearly chart, a monthly chart, a 60-minute chart, a 1 minute. It doesn't matter. The concept stays the same. Okay? And then this, it starts to go what? Parabolic, climactic. Notice the volume. Guys, all you're doing right here is buying into the institution selling. Okay? This is when the general public gets a sniff. You know, like Tesla a couple months back, most of these one-trick biotech stocks, you're just buying into them selling. All right? And then this topping tail, these is just a tug of war of buyers and sellers. The sellers are going, I'm getting out. I already made a profit. And then the general public's getting in. They're going, no, it's going higher. Look how high it is. How do I know this? Guys, sadly, I know this because it happens almost every day in the chat room. Somebody will mention, they'll say, hey, Jared, take a look at XYZ stock. I'll take a look and it's up 8 bars in a row. And I'm like, well, what do you want to do with it? Oh, I want to buy it. Why? Why do you want? Because it looks strong. Well, I'm not denying it's strong, but you're late to the party. Do you want to get to the party as it's closing or want to get to the party before it starts or as it starts? You choose. You want to get there when the boos are gone or when the boos are fresh? I'm not joking. I get this every day in the chat room. Somebody will mention a stock and they'll say, well, check this stock out. And it's literally up 5, 6, 7 bars in a row, some of which are wide range bars. And I'm going, you're new, aren't you? Oh, I'm a momentum trader. No, you're a loser. Okay? Momentum traders get in at the bottom and ride the momentum. They don't get in at the top and take pennies off of it. Think about what I'm saying. Think about it. If it's up 5 or 6, and by the way, I did a lecture on this about a month ago. Up 3 bars, think about selling. Up 4 bars, really think about selling. Up 5 bars, really think about selling, right? I did a lecture on that. Go back and look at it. Okay, so you're all getting in up here. Professional traders and investors get in down here because you know the pattern works. And if it doesn't, you lose 1 R and you move on. But if it works, you're making bank. You don't get in up here. And then what happens? Once the volume increases, guys, a volume spike after multiple bars up is a sign what? It's going to pull back. So here we have what? Let's go over it real quick. Volume spike, a gazillion bars up, topping tails, far from the moving average, climactic. All of those things point to a pullback. Why would you get in up here? They all point to a pullback. Guys, if the stock is extended on the time frame in which you want to trade it, it's extended. It might not be extended on the daily chart, but if it's up 8 bars on the 1 minute and you're going to trade it on the 1 minute, it's extended because you're trading it on the 1 minute. You're not trading it on the daily. We've had this discussion in the past also. Okay? All right. Goes lower, goes lower, goes lower, goes lower, and you're a loser now because you got in up here. That's how it looks. And that's a 1 minute chart. Now, how do you take advantage of these things is the next question. Easy. You know what the cycle looks like. You know when fear peaks, and you know when apathy starts, and you know when greed begins as well, and when greed peaks. So here's a stock that's in a downtrend. Okay? Note, 1 day down, 2 days down, 3 days down, but look at the 4th day down. I want you to take a look. So it's bad enough that the stock drops from 13 to 11.50. Then it drops from 11 to 9. That's bad. But when it drops from 9 to 4.50, that's a 50% drop. Look at the wide range bars. Look at the volume. The volume's so small over here, it's almost imperceptible. Now look at the volume. Okay? Guys, this is a 30-minute chart, and this stock is doing 3 to 4 million shares every 30 minutes. People are dumping this thing like the plague, right? So now you see wide bars after 3 previous days down. You see volume spikes. It starts to bounce. But here's the thing. You don't need to be the first person in the stock. Because if you're right, the stock's going to transition into a stage 2 for a very long time. So what do? Wait for it to break the trend line. The orange line is the trend line. Let it break the trend line, pull back, and retest support. Why? I want to find out if there really are buyers down here. Because buyers stepped up previously. So I want to know if they're willing to step up again. So you could argue to buy some at $5, but it's an aggressive area to buy. If you want to nibble a quarter lot, a third lot, fine. But do not get full at $5. Why? I don't know if the buyers are going to step up yet. Let's let them step up first. So we let the buyers step up right here. They pull back and we get what? A 30-minute 3-bar play. Wide range bar, followed by a narrow range bar, rip. So I've seen buyers step up once, buyers step up twice, buyers step up big time for the third time. We get above the $6 area, and guess what we have room to? Basically back to $9. Little bit of a hiccup at $8.25, but basically back to $9. You're in at $6.50. Your stop is $6.25. It's a 25-cent stop, and you got $8. It's $1.50. It's 6-to-1 in your money in 1 hour, 2 hours, 2.5 hours. That is a 30-minute market cycle. Guess what? Novice traders and novice investors are getting in up here at 9 where the resistance is, or back here at 14. No, you're getting in right off the bottom, right as you start to gain confirmation. So what is our confirmation? Our confirmation is what? Breaking of the trend line. That's confirmation number 1. We broke above the trend line. Okay, right here's the first break, right here, first break. Okay, we pull back, retest the low, but do not break the low. Retest the low, but don't break the low. Retest it again, but don't break the low. Now we bounce. So we've broken the trend line over here. We've retested the low, but didn't break the low twice. Then we put in what? A higher pivot high, okay, and a higher pivot low. So broke the trend line, double bottom retest and failure, broke the prior pivot high and put in a higher low, and we got a pattern. Everything's lining up. Everything's lining up. Okay? Guys, if you're shooting for 2-to-1, you'll be out at $7. It's that simple. If you're shooting for 3-to-1, you'll be out at $7.20. It all depends on your management. The point is there's room to $9 here. Okay? Let's try it again. Here's another example. Stocks in a downtrend, 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 downtrend. Wide range bars here, okay, and wide range bars here. Tell you, wow, this move is getting extended. What's the first warning sign? We break the trend line. That's our first warning sign. Second warning sign, we retest the prior low. But the problem is we could still retest the low and go lower. I need to see something. What do I need to see? I need to see a higher pivot high or a higher pivot low or both. So I break the trend line right here. That's good news. That's bullish. Second, we retest the bottom. Third, this wide range bar breaks this pivot, and this pivot. This wide range bar breaks this pivot, and this pivot. So now what? This is confirmation of strength from the buyers. And then what do we get? A flag. Lower highs, higher lows. It's a wedge or a flag. You're buying it right here at like 46.20. Your stop's going to be down there at like 45.70. It's like a 50-cent stop. Boom. $3 move in what? 2 hours. $3 move in 2 hours. Why? You waited. You were smart. Okay? You didn't aggressively get in down here. You could nibble, but that's aggressive because there's no confirmation here. All right? But this is what professionals do. They get down on the bottom. Let's go back to it, guys. Let's go back real quick, okay? Hold on. Your goal is to get in over here. See it right there? So it's chopping around, chopping around. Get in when it puts in that higher high and the higher low. When it puts in the higher high and the higher low, that's when you're going to get in, okay? So we just saw what it looks like. All right, now that's the chart right there. We're going to do it again. Here's a stock in a downtrend. Okay, if we were to put a trend line on this, right there, right here at the green bar is when it breaks the trend line right here. That's when it breaks the trend line. So we broke the trend line. We did a double bottom before we broke the trend line. That's fine. There's nothing wrong with that. So we broke the trend line, broke above the moving average, above the trend line. Okay, and we put in a double bottom. Then we put in a higher high, right? We broke this pivot. We put in a higher high. We broke this pivot. We put in a higher low right there. There's your buy setup on the weekly chart. Now, I want to be clear. We've done this on a 1-minute chart now. We've done this on a 30-minute chart now. We've done this on a 60-minute chart. Now we're jumping to a weekly chart. Guys, the pattern is the same. The pattern is the same. The concept is the same. Fear, greed, it's the same. The need to be right, it's the same. This is the beauty of technical analysis. Do it on a 2-minute chart, do it on a yearly chart. It's the same concept. Okay? Buy right there at 27, stop is at 26. First target's like 32. 5-to-1 first target, and then after that, target right here, target right here. Okay? All right. Shoot, you're right. I'm going to go 5 more minutes, guys. Okay? I'm going to skip this slide because I just don't have time for it. All right? Trend line break. Here's another weekly chart. Trend line break. Here's your retest. Wide range bar takes out this pivot. Wide range bar takes out this pivot. Okay? Double bottom retest. Breakage of the trend line. Wide bar takes out the pivot. We pull back. That's a higher high. It's a higher low. Entry number 1 right here. Entry number 2 right here. First target is going to be right on the red line, right at like 32 bucks. Buy it right there at like 21, stops at 20. Sell some up here if you want. Add more at 25, sell some at 30, 32. Guys, this is how a stock transitions. Okay? Do not get in up here. Guys, some of you are going, ooh, can I take this here at 45? Well, there's some junk to the left at 45. Be careful. All right, be very, very, very careful. Okay? I'm going to go through these last couple slides a little quick. Why? Because I have to get going. I want to talk about one more thing before I go. I'm going to be 5 minutes late to my meeting. All right. This is the market. I brought this up a couple weeks ago. This is the S&P. Remember I said possible buy points. You don't buy the market up here, guys. You buy it on pullbacks. If you're an investor, you don't buy the highs, you buy the pullbacks. Okay? Now, if you're doing long-term investing where you're taking a percentage of your paycheck and you're putting, say, $500 a month into your Vanguard, that's different. That's different. You're 25, 30 years old and you're like, all right, I want to do this for 30 years. I want to, VT, SAX, ETF. That's different. But if you're going to trade the market, even as a core trader, you buy on breakouts, you buy on pullbacks. You don't buy here. You see this right here? See the breakout. You buy on the breakout here. You don't buy it up here. You buy on the pullbacks. Okay? That is how it's done. Pullbacks to support. Look on the way up. There's your double bottom retest, pullback entry, pullback entry. Okay? These are the areas I talked about a month ago now. 233, 181, 100, and hopefully, God forbid, we don't get to 67 or 100, honestly. Hopefully, we get to 181. I'm looking to add. I've already added some at 233 when the SPY went to 220. I added some at 228, and I'm going to add some if we get into the 180 to 200 range. I don't think we're out of the woods just yet, guys. I really mean that. I don't think we're out of the woods on the market yet. Be good for most people if we were, but I don't think we are. Okay? One other comment before I go. This is off topic. This is a perfect ruler breakdown, guys, on SPG about a week ago. I'm commenting because some of you guys are like, I can never find these things. This was given to me right after my lecture. I've gotten a few emails like, Jared, I can't find those perfect breakdowns you're talking about. Well, I showed you examples during that lecture. And right after that lecture, somebody sent this to me. It's beautiful. $45 is your entry. $45.70 is your stop. And it went $3. It's a perfect ruler breakdown. Okay. It's a perfect ruler breakdown. Okay. So in quick summary, guys, quick summary. If you want to be a trader, really give it some thought. Are you properly capitalized? Do you have realistic expectations? Are you going to treat it like a business? Do you have a trading plan? Okay. What patterns are you going to trade? What markets? NASDAQ, New York, Amex. What stocks are you going to trade? All right. Have you given this some serious thought and consideration? Or are you just like, oh, I'm bored, I'm home, I have to do something, so I'm going to be a trader? That is really a poor way to go into trading. It's really, really a poor way to go into trading. I want to make one last comment. You're probably going to see this chart again at some point. This saddens me, guys. This really saddens me. The U.S. personal savings rate long hovered in the 10 to 12% range, but in the last 2 decades, it has generally remained at a much lower level. So you mean to tell me that people were better off in 2009 and 2010 than they are in 2018? You mean to tell me that people are making less money now? Meaning 10 years of the longest bullish run in the market, and you guys are saving 2 to 3% versus 6% 10 years ago. Okay? Think about that. No, wage growth over the last 2 years was the highest it's been in like 30 years before this all happened. Take a look at it. Wage growth over the last 3 years has been really good. My point I'm simply making is this an income problem or is this a spending problem? You want my guess? It's a spending problem for most people. I am certainly sure there is a percentage of people that have an income problem. But for most of you, this is a spending problem. Okay? For most. Sure, we could always argue it's both. Right? Guys, 2 to 3% savings rate? Really? Okay? In the 1970s, it was 10, 12%. Why am I commenting on this? I'm commenting because with the coronavirus happening right now, after a 10-year run in the economy, people should be in a better position than they are. You know the term, this too shall pass? This too shall pass. The coronavirus will pass. This epidemic will pass. And yes, will the economy feel some pain for a while? Absolutely. Could be a year, could be 3 years. I don't know. But we will bounce again. We always do. But when we do, where will you be on this chart? Will you be at the 10, 12, 20% level? Or will you be at the 2% level? Okay? You should be saving 10 to 20, really 20% of your paycheck. Stop going to Starbucks. Stop shopping at Whole Foods. Put yourself on a budget. I'm not suggesting all of you waste money, but the average American spends 104% of their paycheck. That's negative 4%, in case you're doing math. What are you doing? I'm commenting because we just came off of an unbelievably good 10-year run. We didn't just come off of a bad 10-year run. We came off of a good 10-year run. So if we've come off of one of the best economic expansions in U.S. history and savings is down 4 percentage points, what does that mean if we actually have a recession? You're going to be in soup kitchens. Go back. I'm going to go full circle on you guys. You ready? Psycho-cybernetics is about self-responsibility. Self-responsibility. Okay? Don't worry, I'm going to be done in about 60 seconds. Guys, most people that I spoke to 6 months ago were saying, Jared, we can't find enough qualified people for the positions. That's how low unemployment was. It's not that way now, but let me go full circle. 6 months ago, people were saying, I can't hire people. There's nobody to work. So why is the savings rate 2 or 3%? Ask yourself that. Because you're too lazy to get a second job for most people. Not everyone. There's a certain percentage of people that have 2 or 3 jobs, and it's tough. I have a really good friend of mine. Makes 42 grand a year. Guess what? It's laziness. Pure lazy. He works 38 hours a week. You mean you couldn't work 48? You couldn't get a side hustle for 10 or 15 hours a month? Damn right you could. At $15 to $20 an hour. Damn right you could. You don't want to. You don't want to make that extra $500 or $1,000 a month. That's on you. I'm going to be doing a lecture in the future, guys, on personal responsibility as well as financial responsibility and wealth building. Okay? Because I think personal finance is dead in this country. It's absolutely dead. It's a disgrace. They don't teach it in high schools. They don't teach it in colleges. And your parents don't teach it either. It's a disgrace. Take some self-responsibility. All right. I hope you guys learned a little bit today, guys. And you'll take some of these lessons and apply them if you want to be a trader. Hopefully you'll be smart enough not to take $12,000 in student loans and blow it. All right. And hopefully you'll be smart enough to really think this business through before you start this business. All right. So that'll do it for this week's lecture. I'm Jared Wesley. We'll get back at it next week. Take care, guys.
To get more great educational content, subscribe to the Live Traders YouTube channel. This way you'll get email alerts every time I upload a new video.